B&Q owner Kingfisher surprised investors with better than expected results this week, and that prompted its stock price to rise by more than 17%. That's good news in an otherwise uninspiring trajectory for the FTSE 250 company, which has been one of the UK's most shorted stocks. In a further boost, Kingfisher will now launch an accelerated buyback programme amid upgraded full-year guidance of between £480 and £540 million. Year-to-date, shares in Kingfisher, which owns B&Q, Screwfix and TradePoint, among other European DIY brands, are up 18% to just under £3 per share, showing just how crucial this week's results have been to its progress. Over 12 months, Kingfisher stock is still down 10%, however, and over 5 years, shares have barely moved. So why did Kingfisher's stock price spike? Well, crucially, Kingfisher's half-year results this week surpassed expectations. UK sales growth was driven by warm summer weather and the closure of home-based stores, which drove customers towards B&Q. Sister UK brand TradePoint also increased its contributions to Kingfisher's sales growth. In Europe, Kingfisher did better than many expected too. In Spain, big-ticket items and demand for home repairs in Valencia after last year's flooding boosted sales by over 10%. And in France, where Kingfisher runs home improvement brands Castorama and Brico Dépôt, sales fell 2%. Not great, but better than feared. The picture across Kingfisher's Poland businesses was also mixed, with some offset from flexible staffing. Overall, against a challenging backdrop, Morningstar equity analyst Jack Fletcher-Price says this was a strong set of results. So why has Kingfisher stock struggled historically? Well, Britain has long been a nation of DIY lovers, of course, and the opportunity to add value to a home is a good incentive to give a house a lick of paint, particularly with a slowing housing market. In 2025, easy cosmetic wins make a good impression on buyers and improve life for those who do decide to stay put. Kingfisher faces other headwinds, however. The UK economy is stagnant for one, rising inflation has squeezed wallets, consumer confidence has dropped, and according to Morningstar's Fletcher-Price, Kingfisher has actually underperformed US peers like Home Depot, which have greater success selling bigger ticket projects to consumers with those larger American homes. To turn its fortunes around, a transformation plan is currently in place, so in some countries that's meant reductions in headcount, in others Kingfisher has closed stores to focus its efforts elsewhere. So what does that mean for you? Is Kingfisher stock a buy, a sell or a hold? Well, for now, Morningstar's Fletcher-Price retains his fair value estimate of £2.67 for Kingfisher stock, making it overvalued after this week's spike. The company does not have a Morningstar economic moat rating, meaning it is unlikely to fend off significant competition from its peers. But get this, a medium uncertainty rating means it is difficult to accurately predict what the company's fortunes will look like in the next decade. What is clear is that Kingfisher is not out of the woods yet. Indeed, it will have to post more evidence of business recovery before it convinces shareholders it has its own house in order. For Morningstar, I'm Ollie Smith.